Hello, folks. Good afternoon. Elio Souza again, America Trust Funding. Um, as stated in so many times before our Friday video. Last week we talked about the FHA rates. You know, my FHA rates is on a low to middle 2% for 30-year fix. We already know that. We talk about what corporate does not want you to know when it comes to government rates and government yield or SRP. Today, we're going to talk about Fannie Mae and Freddie Mac. Those are the two government agents that securitize conventional loan. And that's what we're going to talk about today. And that's the same thing, has the same concept. The concept that, the rate offers you a certain SRP, that's yield, YSP, not as heavy and bigger as the government SRP is on a Fannie and Freddie Mac agency. But there are some, and of course, credit score also is a major player and, gives you more or less SRP. When it comes to conventional rates, in compared to government rates, with the exception of a VA loan, those rates and those two agents, they are more directly to a higher credit score. So when you have a consumer with a lower credit score or a credit score, let's say under 700, if I may say, the adjustment for the rate coupon on a conventional rates are much higher than supposedly on an FHA rate. That's why you see FHA funding a lot of loans, especially in purchase. Every time you think about new money with a low credit score or medium credit score or credit score under 700, definitely for payment and ratios, expenses, debt ratios, income, they'll be recommended to go an FHA. On the next week, I will talk about those two different loans when it comes to income and qualification. But today, it's just a very simple explanation about conventional loan. So Fannie Mae, Freddie Mac. Conventional loan. Fannie Mae, they are capped at 97%. They have a 97% product. You can go to 100, but you have to get a second trust outside of the Fannie Mae agent's mortgage-backed securities. So if you apply for 100% finance, you are able to. Freddie Mac can go to 105%. So that is also it's not very common because when the more you ask the bank, the less you get back. So the higher the risk is, of course, the higher the cost, the higher the rate. But conventional rates, okay? America Trust Funding, because we are price leader lender, for many, many years, we are, being probably the pioneer in rates for, I would say, 10 or 12 years or so. We change our platform of business to be more aggressive and try to accomplish a lot of consumers, a lot of clients versus less clients and higher rates like many of the direct lenders, many of other brokers you see, or even banks, that they want to maximize their earnings by getting a big SRP from every single consumer. That is not our platform of business. Our platform of business has been, since I opened the company, based on volume. So I'd rather be year-round, very competitive, very busy, with a great volume, steady volume, and always make money. I always have revenue coming into the company. But coming back to the rate, okay? As you know, the FHA rates last week, we talked about coupons 2.5, 2.25, 2.7, 2.7 today in an FHA. I am giving back some lender credits to the consumer. On a conventional, okay? Conventional loan, when you put it a 3 or 5% down payment, okay? On a 3% down payment, you must be a first-time home buyer. What is a first-time home buyer under the eyes of guidelines? Oh, I bought a house 20 years ago. my husband or my mom added me to the title. You're not a first-time home buyer anymore. Oh, I sold my house 5 years ago. You're not a first-time home buyer anymore in the state of Maryland. You only lose your virginity once. So that means you only have a chance to be exempted of the state transfer taxes one time in your life. That's not like every 3 years or every 5 years. Oh, I don't own a house, I sold my house. That means you are able to get that freebie from the state. Big no. That is a lot of even agents and attorneys and title company make a lot of mistake about this. The real law says you never exercise that exemption before. Then you can take it. So as a first-time home buyer, you are able to put a 3%. And under the Fannie Mae guidelines, we have one product that's called regular conventional, and also we have a home ready. Why home ready? Home ready is for technically designed for low income individuals. And that is a county, again, the same way we talked about last week, the county restriction for loan amount. Well, guess what? We have a county restriction for income. It's a kind of directly for low income or medium income type of family. In Montgomery County, it's about $95,000. So if you make more than $95,000, you will not gonna be eligible to gain this Home Ready special program. Why is it special? Well, because the MI factor, since you're not putting 20% down payment, you're technically supposed to have MI. Your MI factor is only 25% coverage. So it gives you a much lower monthly income. And for our illustration purpose, we're gonna take $400,000 loan, okay? $400,000 loan. If you put a 3% down payment, you're looking at $12,000 down payment. So you need a loan for $388,000, okay? $388,000, okay? Conventional loan, home ready, right? American Trust Funding, because of our volume, we have a special on this program now. Our rate, we have two types of rates for these programs, okay? The rate is, one is called BPMI, it stands for Borrow Pay Mortgage Insurance, or lender PMI. That means the lender pays the mortgage insurance. But Elio, how the lender is gonna pay my mortgage insurance? It is a catch, yes. It's nothing freebie. When the lender pays the mortgage insurance for you, they are technically not paying. They are increasing the rate coupon to cover the cost of this MI. And on this particular illustration here, today, under today mortgage-backed securities market, right now, at about 3:30 p.m., our rate today for this program, because I just priced before I'm shooting this video, our rate today with the Borrow Pay MI, it's 2.99. That's our rate for 30-year fix. But Elio, what is the MI? Based on this, our MI is gonna be $78 a month, give and take, 78 and a change. Here, your rate is gonna be higher because the lender is covering the mortgage insurance. It's okay, you know, but Elio Souza, as a professional on this field, is going to recommend you this, and I'm going to tell you why I'm going to recommend this guy. So when you get a lender PMI, your rate jumps today, our rate, okay, always remember, your price lead the lender today, Friday, is going to be 3.490. But Elio, what about the payment? I guarantee you, if you have a calculator, if one of the professionals is watching this, you're going to see that this rate, this guy here is still going to offer you a $12 less, based on this illustration, less payment than this guy here. But Elio, MI is not tax deductible. Yeah, it is not. I agree with you. But you pay about $1,000 a year in MI. And if you don't have many deductions, I guarantee you, you're probably not gonna make the $24,000 minimum deductible by the new tax administration law. So paying this, why I'm encouraging you to pay this? Number one, give and take about $1,000 is gonna cost nothing for somebody that buys a $400,000 home that will need an income give and take of $65,000 to $75,000 without any other debt to qualify for this loan. You have a mortgage insurance $78 a month. That it can be eliminated in the near future. You have a minimum of 2 years. You file an affidavit. But if you put a 3% today, that's more likely that the investors and Fannie Mae is not going to waive this $78 because it's only 2 years. But if you do improvements on the house after 4, 5, 6 years, the market increase, right? Your appraisal value increase as you pay down your mortgage on this beautiful rate here offered by American Trust Funding, your principal decrease. So this gap here increases. So the more the gap increases, the more equity you gain on the property. So then after 3, 4, 5 years, you approach the bank again or the servicing company and say, look, I've been paying you for 5 years. I never missed. I would like to waive my MI. Here is a BPO or appraisal. Here's my new balance. Yeah, you finance 97%, but after 5 years, you are way more in equity. The house gained value. You did some improvements. You know, a lot of things to play. After 5, 6, 7 years, the chances that the investor, along with the service, waive the 78, it's pretty great. That means now you have a 2.99, 30-year fix, and you don't have an MI. So that's why I recommend. And my friend, if you are there watching this video, if you buy a house, which you know the appraisal came higher, if you buy a house on the foreclosure, if you buy a house on the short sale, you know that you're already walking the property with some equity. I strongly recommend you to go this guy here. It doesn't make any difference. I will present the case and I will give you my recommendation. The decision is yours. Which one you're gonna take it? You know, a lot of people say, no, Elio, I wanted this here because MI is not tax deductible, whatever. I don't want to be worried about it 3, 4, 5 years. Don't know what's gonna happen. I'll respect that. But I hope it gives you a little bit illustration. When you put in the same scenario, a little bit of a more down payment, your rate remains the same, but your MI goes down. So I'm trying to give it 3% because for first-time home buyer, I think that's very aggressive. If you want to exercise 100%, you can do that too. We do offer 100%, but the first trust has to be at 95, and we do a second of a 5%, which is a home equity line. It's a two different investors. We close on the same day, and here on the 95, our investor is offering prime minus a half. So you'll be able to get a 2.75 interest-only payment on 100% finance, second trust. In this case, here would be about $80K. And then you have a $320,000 loan without mortgage insurance. Recommended here, when you get a two trust, the first and the second, whatever you do in your life, make sure you kill the second trust $80K first, because that's a variable rate. Today's good, tomorrow could be prime plus, 1, prime can go up, your payment will go up. Granted, you only pay 2.75 interest only, but you don't want to expose yourself to $80,000 attached to your beautiful home for many, many years. You want to make sure you pay. So I'm going to finish here. Next week, we're going to talk about, other things on a conventional. But you know that when it comes to rate, American Trust Funding is here to serve you from A to Z. Next week, I'm going to be talking about a little bit of SBA loan, SLA, very few banks and brokers and loan officer knows how to do and has the capacity to do it. So we're going to talk about a little bit about commercial loans, what is involved, and why we do here in American Trust Funding. We are not only a Fannie Mae, Freddie Mac, or a VA type of loan. We do all kind of loan. The only loans that we don't do, believe it or not, the car loans, student loans, things like that. But everything that's related to real estate, either residential or commercial, American Trust Funding, we are open for business, and then we are here to offer. I hope you have enjoyed this video, this illustration, and I'm looking forward to see you next week. Thank you very much for watching. Have a safe and beautiful weekend. God bless you. Ciao.